Picture a guy named Dave, 47 years old, runs a small portfolio of rental properties, an LLC for his consulting work, and a family trust his estate attorney set up 2 years ago. Dave files on time. Dave keeps receipts. Dave pays a CPA $4,000 a year to make sure every number on his return is defensible. Dave sleeps well at night because he believes the deal is simple: report honestly, and the government leaves you alone. Dave is about to learn that honesty was never the variable that mattered. One Tuesday morning, Dave gets a letter, not the Garden Variety CP 2000. Notice that half his neighbors have received. This one references his LLC, his wife's sole proprietorship, the trust, and a family limited partnership he barely thinks about: a coordinated examination, multiple entities. Multiple agents. The IRS is not asking Dave to clarify a deduction. They are dismantling his entire financial architecture at once, checking every wall, every joint, every wire behind the drywall. And the reason has nothing to do with a mistake on line 27. The reason is that Dave crossed a number, a net worth threshold. That is it. Here is the part that should unsettle you. Before Dave ever sat down with his CPA, before he opened TurboTax, before he typed a single digit into any box, the IRS already had his income figured down to the cent. He calls his CPA, the same one he has used since he was making $60,000 a year, and within 48 hours, he learned something that will cost him more than any tax bill ever could. His defensible positions are backed by confirmation emails he cannot locate, mileage logs he never kept, and business purpose notes that exist only inside his own head. The next 6 weeks of his life will be consumed by reconstructing records from credit card statements and old calendar entries. His accounting and legal fees will land somewhere north of $15,000 before a single adjustment is even proposed. And the slow, grinding anxiety of operating under federal examination while simultaneously running a business will bleed into his sleep. His relationships, and his ability to think clearly about anything else. All of it was avoidable, every dollar, every lost hour. Every night, scrolling through bank statements at 1 in the morning. The question worth asking is not whether this man did something wrong. He did not. The question is why the system selected him in the first place, and the answer is pure arithmetic. The IRS processes north of 200 million returns every single year. It does not have the manpower to examine all of them, so it runs a statistical scoring model to decide which ones deserve a human set of eyes. When your return lands inside the expected range, for someone at your income level, your score stays low and your file sits quietly in a digital warehouse. But when your deductions run high relative to your earnings, when your business losses look conveniently proportional to your W-2 income, when your charitable giving sits well above the median for your bracket, that score climbs. A climbing score does not mean you cheated. It means you became statistically interesting to a machine that needs to ration scarce attention across an ocean of filings. Here is where the math turns personal. The baseline audit rate for the average American taxpayer is roughly 0.4%. That is the background hum, the noise floor. Most people never hear it. But once your combined income from wages, business revenue, capital gains, and rental distributions starts landing between $200,000 and $400,000 a year, which in practice maps to roughly $1 million in investable assets, you cross the first threshold where the system recalibrates how it sees you. In that $200,000 to $500,000 income band, the audit rate pushes toward 1%. Between $500,000 and $1 million in annual income, it reaches approximately 1.4%. Above $1 million of reported income, it hits 2.5% and keeps climbing from there. That is a six-fold jump from the average, not a rounding error, not statistical noise. A mechanistic escalation driven specifically by the types of income sources and deduction categories that show up on a return for the first time at this wealth level. Think about what happens to a person's tax profile the moment they cross that $1 million net worth line. Suddenly, they are running a Schedule C with real revenue and real expenses. They have rental income from a property or two. They are sitting on capital gains from investments that have actually appreciated. They might be claiming a home office or writing off vehicle use. They have probably made their first sizable charitable donation. Each one of those line items, taken alone, nudges the score upward, stack several of them on the same return, and you produce a profile that looks genuinely fascinating to a revenue agent scanning the review pile. Not because anything is fraudulent, but because your financial life no longer resembles the person earning $45,000 with a single W-2 and a standard deduction. You have become a different species of taxpayer, and the system treats you accordingly. The danger at this level is not the audit itself. Audits can be survived cleanly if you are prepared. The danger is the gap between the complexity of your financial life and the infrastructure you have in place to document it. Most people who reach a million in net worth never upgrade their tax setup. They keep the same CPA they hired. When their biggest worry was whether to itemize, they file the same forms they used when their situation fit on 2 pages. They claim deductions they picked up from a finance forum and support them with a vague sense that the expense was probably business related. Every one of those positions might be perfectly legitimate. But legitimacy without documentation is just a story you tell yourself until someone asks for proof. And at this income level, someone is 6 times more likely to ask. The cost of that gap is not abstract, it is weeks of lost productivity. It is 5-figure professional fees arriving before any resolution is even on the table. It is the corrosive weight of a federal examination pressing down on your chest while you are trying to close deals, manage a team, or simply be present for the people who depend on you. Every dollar of that cost traces back to one failure, crossing a financial threshold without rebuilding the system that was supposed to protect you on the other side of it. And that brings us to what surviving at this level actually requires. At $1 million in net worth, the single most consequential financial act you can perform has nothing to do with asset allocation. It is not about finding a slightly cheaper index fund or rebalancing your portfolio on some quarterly schedule. The thing that separates people who survive contact with the IRS from people who do not is paper receipts, logs, a documentation system that accounts for every deduction claimed, every business expense filed, every charitable contribution reported, every rental property cost recorded. Not because an audit is guaranteed, because if one arrives, the only currency that matters is evidence, and your memory is worth exactly zero. At the $1 million mark, the IRS has 3 years from your filing date to open a standard audit. 6 years if they suspect you understated income by more than 25%. So every year you spend without building airtight records, you are not just being careless. You are stacking another 12 months of exposure on top of the last. That cost compounds in exactly the way your investments are supposed to compound, except it works against you silently, in a direction you cannot see until the letter arrives. The wealthy understand this, not because they are smarter, because someone told them early that the game at this level is not about returns, it is about administration. And the people who never get told, the ones still focused on which brokerage has the lowest expense ratio, those are the ones feeding the machine. Now move up, cross into the 3 to 5 million range, and the nature of what is watching you changes completely. You are no longer a line item flagged by an algorithm sitting in a queue with 10,000 other returns, waiting for a revenue agent to maybe pick up the file. You are now potentially inside the scope of something called the Global High Wealth Industry Group, a coordinated examination program the IRS built starting around 2009 and has been aggressively expanding since the Inflation Reduction Act of 2022 delivered new enforcement funding and new staff. This team does not audit your tax return. They audit what the IRS calls your economic family. Every entity connected to you examined simultaneously: your LLC, your trust, your S Corp, your family limited partnership, your donor advised fund, your spouse's business entity. All of it cross-referenced against all of it. Picture what that looks like from the inside. They are not checking whether a number on line 7 of your Schedule D is accurate. They are mapping the movement of cash across every entity in your orbit. looking for transactions that appear perfectly clean when examined inside one structure and perfectly clean inside another, but tell a completely different story when you trace the full path from origin to destination. Think of it like a merchant operating in Amsterdam at the height of the Dutch Golden Age, running a trading house, a shipping operation, a lending business, two properties, and a stake in a spice venture. Each ledger, reviewed alone, is spotless. But the inspector who lays all five ledgers on the same table and follows the money from the trading house through the ship's accounts, through the lending operation, and out to personal use without it ever being recorded as personal income, that inspector sees the circle instantly. The global high wealth team is looking for that circle, and here is the part that should sit heavy in your chest. Most of the people they examine at this level never built a circle. They are not hiding anything. They set up every entity on legitimate advice for legitimate reasons. But the sheer volume of inter-entity transactions, the management fees flowing between the LLC and the S-Corp, the related party loans, the intra-year carry forwards, all of that legitimate complexity almost guarantees that somewhere inside the web there is a distribution that could have been characterized differently. A business expense that requires a strong argument to defend, a compensation arrangement that sits in a gray zone. Not fraud, just enough technical aggression baked into the structure itself that an examiner with the full picture will find something worth questioning. The system does not need you to cheat. It just needs you to be complex enough that complexity itself becomes the vulnerability. And that is the quiet truth about who gets harvested at each tier. It is not the people cutting corners. It is the people who followed every piece of professional advice they were given without realizing that the advice created the very architecture the next level of enforcement was designed to dismantle. Picture a management consultant, mid-40s, sitting in a conference room he is paying $400 an hour to occupy. Across the table, two members of the IRS Global High Wealth team have spread 18 months of his financial life across laminated folders. They are not accusing him of fraud. They are questioning whether the $140,000 salary his S corporation paid him was genuinely reasonable when he personally generated $1.2 million in billings that year. His CPA set that number. His CPA had been setting numbers like it for years for dozens of clients, and nobody had ever blinked. But the team across the table is arguing a comparable third party doing his exact work would command $220,000, maybe $250,000. The difference in employment taxes on that gap is not life altering. But it is enough to justify the government's time, and here is what nobody told this man 3 years ago when the fix would have cost him less than a dinner for two. The position he is defending was legitimate the entire time. He will probably win. Many taxpayers do win reasonable compensation arguments, but winning costs him 18 months of his attention, 5 figures in legal fees, and a kind of low-grade dread that sits behind his sternum every time he opens his mailbox. That is the price of being right without proof. The IRS at this level is not listening for screams. They are listening for the quiet hum of aggressive but defensible positions that, when successfully challenged, produce adjustments worth $50,000, $100,000, sometimes more. That is a positive expected return on their examination resources. They are not hunting criminals at the $3 to $5 million mark. They are hunting the gap between what you documented and what you could have documented. A management fee set without a contemporaneous arm's length analysis. A valuation pinned to the low end of reasonable instead of the midpoint. A salary figure your CPA called defensible, but never stress tested against what the other side would argue in a room you are paying to sit in. So here is the action. Once a year before you file, you sit down for 60 minutes with a tax attorney who has actual examination experience. Not your CPA prepares returns. This person has sat across the table from the global high wealth team. They know how inter-entity transactions get mapped. They know which compensation arguments survive and which ones collapse under the specific pressure the IRS applies. They know what documentation the examination team looks for and what gaps they exploit. You hand this person your entity structure, your fee arrangements, your salary figures, your trust documents, and you let them stress test every position as if the IRS were already in the room. 1 hour, once a year, the cost is a fraction of a single billable day in an active examination. What you are buying is not advice. You are buying the paper trail that makes your file boring. You are buying the contemporaneous analysis that turns a $140,000 salary from a number your CPA picked into a number supported by a documented arm's length methodology that the other side has to work to dismantle. You are buying the kind of preparation that makes an examiner look at your file, calculate the expected return on challenging your positions, and decide the math does not work in their favor. Do not tear down your S Corp. Do not dissolve your LLCs. Do not abandon the structures that give you liability protection, tax efficiency, and estate planning utility. Those structures are doing exactly what they were designed to do. The problem was never the architecture. The problem is that nobody walked through the building once a year checking whether every door was locked. Keep one more person in your mind as we go forward. A real estate developer, early 50s, who by 2019 had built roughly $12 million in net worth through commercial partnerships, a development company, and a portfolio of index funds. His estate plan was sophisticated. His entities were properly structured and, unusually, properly administered. He had done everything, right? What happened when he crossed the next threshold is the thing that changes the entire nature of this conversation. Because at $10 million, the IRS stops caring primarily about what you earned last year and starts examining what you have arranged to pass to the next generation without it ever being taxed. The federal estate tax exclusion sits at roughly $13.6 million per individual. As of early 2026, $27.2 million for a married couple. But that number is scheduled to fall hard when the Tax Cuts and Jobs Act provisions sunset, potentially dropping to around $7 million per person. That looming cliff is driving everyone in the 8 to 15 million range into the same rooms, having the same conversations with the same estate attorneys about the same set of strategies. And those strategies, the ones that worked cleanly at the level below, start producing very different consequences once the stakes climb this high. Here is how the story ends for the real estate developer, not with a dramatic courtroom scene or a headline in the business section. It ends in a conference room with beige walls and a speakerphone where his tax attorney is negotiating a settlement figure with an IRS appeals officer he has never met in person. The number they land on is not catastrophic, it is not ruinous. But it is large enough that his wife asks him at dinner that night whether they should sell the lake house, and he says no too quickly, and neither of them finishes the bottle of wine they opened. That is the real texture of a tax dispute at this level. Not bankruptcy, not prison. Just a slow, grinding renegotiation of what you thought you had conducted by professionals on both sides who do this every single week and feel nothing personal about any of it. His family limited partnership was legal, his estate attorney was competent, his appraiser was credentialed. And none of that mattered enough because the architecture was right, but the maintenance was neglected. And the IRS examination team that showed up 18 months after he filed those gift tax returns did not care about his intentions. They cared about his documentation. They cared about whether the 35% valuation discount his appraiser applied to those limited partnership interests could survive a line by line challenge from agents who had seen that exact discount claimed on hundreds of similar structures and knew precisely where the soft spots lived. Now I want you to sit with that image for a moment, not because I want to scare you. Fear is a terrible financial advisor. I want you to sit with it because it contains the only honest promise I can make you at the end of everything we have covered today. And that promise is not that you will get rich. It is not that these strategies will multiply your wealth. It is not that there is some hidden level of financial sophistication that, once unlocked, makes the system work in your favor forever. The promise is much smaller than that and much more valuable. The promise is that you can build a financial life that survives inspection. That when someone with authority and resources decides to open your file and examine every entity connected to your name, they find exactly what they expected to find, and they close the file and they move on to someone else. That is the entire compound return I am offering you, not a doubling, not a windfall, a clean file that stays closed. The second version of yourself did something different, not something dramatic, not something expensive. You did three things, and each of them was boring, and each of them took less time than you spend choosing what to watch on a Friday night. First, you sat down with every entity you own, every LLC, every trust, every partnership, every S Corp, and you asked one question about each of them. If an IRS agent pulled this entity S return tomorrow and compared it against my personal return, would the numbers match? Would the K-1 S reconcile? Would the ownership percentages on the entity return match the ownership percentages on the operating agreement? Would the distributions reported on my personal return match the distributions recorded in the entity's books? You did not need a lawyer for this. You needed a Saturday morning and a cup of coffee and the willingness to look at your own paperwork with the same skepticism that a revenue agent would bring to it. And where the numbers did not match, you fixed them, not next quarter, that week. Second, you called your appraiser. The person who put a number on the value of whatever asset you transferred into a trust or a partnership or gifted to your children, and you asked them one question: have you testified in tax court on this specific asset type in the last 5 years? Not have you done appraisals. Not are you credentialed. Have you been in the room where the IRS challenges these numbers, and did your methodology hold up? If the answer was no, you found someone whose answer was yes. Because the discount you claimed on that gift tax return, whether it was 25% or 35% or 40%, is only as defensible as the person who calculated it. And the IRS knows the difference between a generalist who checked the boxes and a specialist who has survived cross-examination. Third, and this is the one that costs you nothing but protects you more than the other two combined, you scheduled an annual coordination review. One meeting once a year where your CPA, your estate attorney, and your financial advisor are all in the same room at the same time, looking at the same set of documents. Not three separate meetings where each professional sees only their piece of your financial life and assumes the other two are handling the rest. One room, one table. All the returns, all the entity documents, all the trust instruments, all the appraisals spread out where everyone can see everything at once, because the IRS does not examine you in silos. When they send a coordinated examination team, those agents are looking at your personal return, your entity returns, your spouse's returns, and your trust returns simultaneously. They are cross-referencing everything against everything. And if your own advisors have never done that same exercise, you are walking into a fight where the other side has better preparation than you do. That is the entire playbook. Reconcile your numbers, verify your appraiser, coordinate your advisors. Once a year, 3 actions. None of them require you to change your investment strategy. None of them require you to abandon the estate planning structures your attorney recommended. They require you to do something differently with your paperwork. And I understand that paperwork is not why you built your business or grew your portfolio or took the risks that got you to whatever net worth level you are sitting at right now. Paperwork is not exciting. It does not compound. It does not appreciate. It just sits in a filing cabinet or a cloud folder, doing absolutely nothing until the one day it becomes the only thing that matters. I want to be honest with you about something else, because this is the closing, and I would rather leave you with clarity than comfort. Everything I have described today, the 3 net worth thresholds, the escalating scrutiny, the coordinated examination teams, the specialized IRS units dedicated to challenging specific estate planning strategies, all of it can feel like the system is designed to punish you for succeeding. It is not. The system is designed to collect what the law says is owed, and it allocates its enforcement resources based on where the largest gaps between what is owed and what is paid are most likely to exist. That is not personal. That is arithmetic. The IRS is not your enemy. They are a bureaucratic institution with a budget, a mandate, and a limited number of agents, making rational decisions about where to deploy those agents for the highest return on enforcement investment. When you understand that, the fear goes away. Not because the risk goes away, but because the risk becomes something you can manage with systems instead of something you have to manage with anxiety. The compound effect that actually matters in this arena is not the compound growth of your investments. It is the compound credibility of your documentation. Every year that your returns are clean, every year that your entities are properly administered, every year that your appraisals are current and your advisor coordination is documented, you are building a track record that makes you progressively less interesting to an examination team. Not invisible, never invisible, but boring. And boring in the context of IRS enforcement is the most valuable thing you can be. Close that gap. That is the only action item, not a new investment, not a new entity, not a new strategy. Just close the gap between what you have built and what you can prove. Because the people whose job it is to look will eventually look. And when they do, the only question that matters is whether what they find matches what you reported. If it does, they move on. If it does not, everything else you have built becomes a negotiation in a beige conference room with a speakerphone, and the wine you open that night will not taste the way you hoped. Boring, methodical, well-documented financial hygiene has quietly protected more wealth across more generations than every exotic strategy, every aggressive discount, and every clever structure combined. That is not a headline anyone will click on, but it is the truth. And it is the only promise worth making because it is the only one that actually compounds.